One of the more serious macro questions investors have begun asking in recent weeks is what would actually happen to property markets in the UAE if there was a disruption in the Straits of Hormuz. It is not a sensational question, it's a strategic one. Because when geopolitical tension increases in the Gulf region, investors naturally begin examining infrastructure choke points, trade routes, economic dependencies in order to understand how risk might translate into real-world financial impact. The Strait of Hormuz is one of the most critical maritime corridors in the global energy system. A significant percentage of the world's oil exports pass through this narrow waterway, and any perceived threat to its stability can influence energy prices, shipping insurance costs, logistics planning, investor sentiment far beyond the Middle East itself. So when headlines begin referencing the possibility of disruption, it's understandable that property investors, particularly those outside the region, start questioning whether this could weaken confidence in markets such as Abu Dhabi or Dubai. However, as with many geopolitical scenarios, the implications are rarely as straightforward as they initially appear. Property markets do not respond purely to single variables. They respond to a complex combination of capital flows, economic expectations, migration trends, and long-term planning assumptions. In order to understand what disruption to the Strait of Hormuz might mean to the UAE real estate, it is necessary to step back from the immediate headline risk and to examine how investors, governments, and financial systems typically react to those type of events. The first thing is to recognize the disruption to strategic trade routes tend to influence global markets in asymmetric ways. While certain sectors may experience volatility, others may benefit from rising commodity prices, increased regional investments, or shifts in geopolitical alliances. Energy exporting economies in particular can experience unexpected capital inflows when supply constraints push oil prices higher. Historically, periods of elevated oil prices have strengthened fiscal positioning across parts of the Gulf, enabling governments to accelerate infrastructure spending, stimulate domestic demand, and reinforce economic diversification strategies. This matters for property markets because real estate demand is closely linked to liquidity, employment confidence, and long-term growth expectations. If higher energy revenues support public investment, business activity, and job creation, then residential and commercial property demand may remain resilient even when geopolitical narratives feel negative. Investors who focus only on the risk headline may overlook the secondary effects that can strengthen the underlying fundamentals. Another important consideration is the UAE's strategic positioning in response to regional risk. Over the past 2 decades, the country has invested heavily on logistics diversification, alternative ports, aviation connectivity, and inland infrastructure designed to reduce dependence on any single route. These investments are not accidental. They were part of a broader recognition that resilience in a globalized economy requires redundancy, flexibility, and long-term planning. When investors evaluate risk today, they are not simply assessing geography, they are assessing preparedness. Dubai's transformation into a global aviation hub, its development of free zones, financial centres, and international business districts, and its continued emphasis on digital and service-based industries all contribute to the perception that the economy is no longer defined purely by regional trade constraints. This diversification can provide reassurance to long-term investors who understand that property demand is ultimately shaped by population growth, corporate relocation, and lifestyle migration rather than by isolated logistical scenarios. At the same time, the psychological dimension of disruption cannot be ignored. Markets are influenced not only by fundamentals, but also by perception. If international media coverage intensifies around the Strait of Hormuz, some investors may initially adopt a wait-and-see approach. Transaction timelines may extend, certain buyers may seek additional reassurance regarding safety, currency stability, or long-term economic outlook. This phase of hesitation is typical in any market experiencing heightened geopolitical tension. However, hesitation is not the same as withdrawal. In many historical cases, once investors gain clarity on actual impact of the disruption, confidence returns relatively quickly. Markets that are supported by structural demand often rebound strongly once uncertainty becomes quantifiable rather than speculative. Dubai has experienced multiple cycles in which sentiment softened temporarily before renewed capital inflows accelerated activity. This pattern reflects the city's ability to position itself as a solution to global uncertainty rather than merely a participant in it. Another dynamic that can emerge during strategic disruption is capital rotation. Investors managing diversified portfolios may reduce exposure to volatile equity markets or emerging risk zones and increase allocation toward tangible assets in globally connected cities. Property locations offering tax efficiencies, regulatory transparency, and lifestyle appeal can be particularly attractive in these phases. The UAE's reputation for safety, governance, and infrastructure reliability plays an important role in this context. Migration behaviour also deserves attention. If geopolitical tension affects neighbouring regions or influences corporate risk planning, multinational firms may reassess operational footprints. Employees may be relocated. Regional headquarters may be consolidated into jurisdictions perceived as stable. These shifts can drive residential demand even when broader sentiment appears cautious. Property markets are deeply influenced by human movement, and human movement is often accelerated by strategic uncertainty. Currency considerations further complicate this picture. During periods of global instability, investors frequently seek exposure to assets linked to a stronger or more predictable monetary environments. The dirhams linked to the US dollar can therefore enhance confidence amongst international buyers concerned about the exchange rate volatility. Holding property denominated in a dollar-pegged currency while benefiting from local growth dynamics can be seen as a form of hedging within a broader wealth strategy. It is also important to distinguish between short-term transactional softness and long-term valuation trends. Property markets rarely experience immediate repricing solely because of geopolitical risk. Valuation shifts tend to occur when structural drivers such as employment levels, population growth, or financing availability change significantly. If this disruption to the Strait of Hormuz does not fundamentally alter these demand drivers within the UAE, then the long-term price trajectories may remain intact even if deal velocity fluctuates. Experienced investors often recognize this distinction. They understand that moments of heightened uncertainty can create negotiation leverage, more flexible payment structures, or improved access to premium developments. For buyers who believe in the long-term trajectory of cities like Dubai, these windows can represent strategic entry points rather than reasons to retreat capital entirely. Institutional capital behaviour reinforces this perspective. Sovereign funds, pension allocations, and family offices typically operate on multi-year investment horizons. Their decisions are guided by demographic analysis, infrastructure commitments, and policy continuity rather than short-term sentiment. When they evaluate markets facing geopolitical headlines, they ask whether the underlying growth story has changed. If diversification, urban expansion, and global connectivity remain intact, their conviction often remains stable. Of course, it would be unrealistic to suggest that disruption to a major trade corridor carries no risk. Energy price spikes can influence inflation, shipping costs can affect supply chains, insurance premiums can rise. These factors can shape economic expectations and consumer confidence. However, risk must be weighted against resilience. The UAE's track record of adapting to regional complexity has become part of its investment narrative. For many international buyers, the country's ability to function as a bridge between continents is precisely what makes it so attractive. Strategic positioning means exposure to opportunity as well as exposure to uncertainty. Investors who understand this duality tend to focus less on the worst-case scenarios and more on probability-weighted outcomes. Another angle worth considering is the role of the development pipelines. The UAE continues launching large-scale residential communities, commercial districts, and tourism initiatives designed to support long-term population growth. These projects are not typically paused because of short-term geopolitical fluctuations. Their timelines reflect decades of planning. When investors see cranes still operating, infrastructure still expanding, and regulatory reforms still progressing, they often interpret these signals as evidence of confidence from policymakers themselves. Market psychology therefore evolves in stages. Initial concern gives way to analysis. Analysis leads to differentiation between noise and substance. Eventually, capital begins repositioning according to where it perceives the strongest combination of stability and growth. In previous cycles, Dubai has often emerged as a beneficiary of this process. Property demand may not surge immediately during periods of tension, but it rarely disappears entirely. Instead, the composition of buyers shift. Some participants become more cautious, while others become more motivated by long-term strategy. This rebalancing can produce a more disciplined market environment, where pricing discussions become more rational and opportunities become more visible to those willing to look beyond the headlines. Ultimately, the question of what happens to the UAE property if the Strait of Hormuz is disrupted cannot be answered with a single prediction. It depends on the duration, severity, global economic conditions, and investor perception. But history suggests that markets built on diversification, connectivity, and strategic planning are more resilient than they appear during moments of heightened geopolitical focus. For investors, the key is to separate scenario analysis from emotional reaction. Understanding how capital has behaved in previous disruptions can provide valuable context. Recognizing that uncertainty often reshapes demand rather than eliminating it can open up new ways of thinking about timing and positioning. If you are currently evaluating how regional developments might influence your property strategy in the UAE, it may be helpful to consider not only the risks, but also the structural strengths that continue to underpin the market. If you'd like to explore how these macro dynamics could affect negotiation opportunities, pricing, or long-term investment planning, feel free to reach out.